Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at some of the best dividend paying companies you can buy right now for under $50. We're going to take a look at 5 individual companies who pay out a growing dividend to their shareholders each and every year. The payouts are considered safe, and for each of these 5 companies, we're going to go over their current operations, their financial performance, and their current dividend information. And as well, I've selected companies from very different segments of the market. We have companies from 5 individual sectors, so there's no overlap. We have a financial company, a communication giant, a big pharma play, a consumer staple, and even a tech company included in this video. So a nice diversified list of dividend paying companies currently trading below $50. So before we jump into stock number 1, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and of course we track the progress of my personal dividend portfolio that now sits at a value of $178,000. So please hit that like button and subscribe. And now we're going to jump into the first dividend paying company we're going to take a look at in the video, and that is ticker BAC for Bank of America. They currently trade for $35 per share. The share price has fallen 23% on the 1-year chart. They now sit with a forward PE ratio of 10 and a current dividend yield at 2.5%. Bank of America is the second largest US bank in terms of total assets, just trailing behind JP Morgan Chase. And as interest rates continue to rise, that has a direct correlation on the bank's ability to generate more interest income, which is a major driver of their total profits. If we take a look at their latest quarterly report, the company is very profitable, generating $7.1 billion of earnings in the latest quarter. Revenue saw a massive increase, up 11% year over year, and their net interest income, of course, which has a direct correlation to the Fed's interest rate, was up 29% year over year as well. The company, of course, did increase their provision for credit losses, and overall, they bought back $1 billion of common stock in the quarter and paid out $1.8 billion in their common share dividends. So overall, this company saw incredible growth in 2022 from all 4 of their main business segments. Their consumer banking, they added over 1 million new checking accounts. Their global banking, the average loans and leases grew 14% year over year. They added 28,000 global wealth clients, and sales in their global market division grew 9% year over year as well. So the company was growing on all fronts in 2022. And if we take a look, according to Simply Wall Street, they're actually considered 23% undervalued at this current price point at around $34 per share, with an estimated fair value at around $45 based on this company's discounted cash flow analysis. So you can pick up shares of a company that's currently expected to be trading at an undervalued price point that has not only returned value to their shareholders in the form of a quarterly dividend, but also by doing a ton of share buybacks quarter after quarter. Back 7 years ago, the company had around 11.26 billion shares outstanding. Fast forward to the latest quarterly report, that number has shrunk all the way down to 8.15 billion. This company buys back a ton of their shares year after year. They continue to reduce that outstanding share count, returning billions and billion dollars of capital to their investors quarter after quarter. And of course, that comes along with their growing dividend they pay as well. Bank of America has a current yield at 2.52%, a payout ratio of only 27% of their net income, a 5-year dividend CAGR at 17%, and they've grown their dividend for 9 consecutive years. So Bank of America is the first dividend paying company worth taking a look at that currently trades below $50 per share. They operate in the financial sector, they're considered undervalued, they grow their dividend quarter after quarter, and they do a ton of share buybacks, which is an incredible feature to note for potential dividend investors. So this was stock number 1 of ones to keep on your watch list, and now if we transition right into stock number 2, we have ticker HRL for Hormel Foods. They currently trade for $44 per share. They're down only 4% on the 1-year chart, and this is a consumer staple company. We can see they're sitting right around their 52-week low at this current price point. They're trading with a forward PE ratio of 23.7, and they have a starting dividend yield at 2.5%. Now if we take a look at the company's latest investor presentation, Hormel Foods operates by having different food products sold in every area of the grocery store. They have some meal and protein products, some snacking goods, some products that deliver global flavors, some emerging brands. These are companies they've recently acquired or put into market that they're hoping to grow rapidly over the next few years. They also have some bacon products and some value-added meats. So as you walk around your local grocery store, you will see a bunch of different variety of Hormel Foods in every area that you shop. And if we take a look at their recent financial performance, the company has delivered 3 consecutive years of top-line revenue record highs. So year after year, the company's achieving new highs overall, and they've gone from $9.5 billion of total sales back in 2019 all the way up to over $12.4 billion in 2022. So that's some pretty rapid expansion for a company that operates in the boring and slow growth food industry. Overall operating income over the past year grew 17% year over year as well, which is very, very impressive. And their planters and corn nuts delivered over $1 billion in sales from the snack nut division. And if we take a look overall, this company's in a pretty healthy financial position. They generate consistent operating cash flow year in and year out. And if we take a look at the balance sheet, they have around $1 billion of cash on hand, total debt at $3.3 billion, and they returned EBITDA over the past year at $1.6 billion. So if we take a look at their cash and subtract it from their debt, that would leave $2.3 billion of net debt on the balance sheet. What you want is the company's ability to generate enough EBITDA over 3 consecutive years to pay off all their long-term debt. This company can do that in less than 1.5 years. So this company is very safe in terms of their balance sheet, and they're in a very strong financial position. And of course, if we take a look at their dividend, this company is a dividend king. 57 consecutive years of dividend increases. They've been growing that dividend each and every year through every recession and depression we've gone through. In 57 straight years, they've continued to deliver a growing dividend to their investors, and their 10-year dividend CAGR is at 12%. So for a lot of dividend kings out there, you're getting minimal dividend appreciation. You're getting anywhere from 1 to 4% annual growth. The growth is either matching or slightly outpacing inflation, but with Hormel Foods, you're getting a consistent and rapid expansion in your dividend over the long term, and they've paid a dividend for 94 consecutive years without an interruption. They've grown it for 57 straight, but they've been paying out a dividend for 94 straight years. So overall, if you're going to evaluate a company and their ability to pay out this cash to you as an investor through tough market conditions, I think Hormel Foods has undergone enough historical history to show that they can pay out a dividend for 94 straight years without missing a payment, grow it for 57 straight. It really does show they are committed to that dividend, and I think going forward, the dividend will continue to grow over the long term. Taking a look at their dividend safety score, they have the highest rating possible. 99 is the highest dividend safety score you can achieve. It comes in at very safe. So again, another company that's pretty much highly unlikely to be cut anytime soon. So Hormel Foods is definitely a company worth taking a look at. They were the second dividend paying company trading below $50 that I'm going to go over in this episode. Next, the third company we're going to take a look at in the video is ticker PFE for Pfizer. They currently trade for $44 per share, and this big pharma company has been in the news dramatically over the past 3 years because of their production of a vaccine, which has completely changed their business. If we take a look, they're still down 16.5% on the 1-year chart. They trade with a very low forward P ratio of 7 and a nice starting yield at 3.6%. If we jump over to the company's income statement, we can see how they performed pre and post pandemic. Of course, this company's been a main supplier of a vaccine on a global scale, which has led to an absolute massive explosion in their total top line revenue from around $40 billion prior to the pandemic to around $81 and then soon $100 billion in the trailing 12 months. So of course, these sales are going to decline. These sales are going to dissipate over the upcoming years because of the demand for the vaccine to decline as we go forward out of this global pandemic. But of course, this company over the past few years has generated so much profits from this vaccine that it's completely changed the health of their business. If we focus on the balance sheet for Pfizer, this is where I believe it can be an attractive dividend paying company going forward. If we take a look at their cash position for one of the metrics we're going to take a look at. Prior to this pandemic, they had around $9 to $12 billion of cash on hand in 2019 and 2020. Then of course we can see a major explosion from all the profits they generated to over $36 billion of cash on hand as of the latest quarter. And now if we compare this cash to their total long-term debt on the balance sheet, they have around $33 billion of total long-term debt. Meaning if you just evaluate cash to debt, regardless of the other aspects on the balance sheet, this company is in a net positive position for the first time in decades. This company has not had more cash than long-term debt over the last 10 years ever, and the company has completely improved their financial health. Just a few years ago, prior to the pandemic, this company was still one of the top pharma players, especially with a nice yield of around 4%. But if we take a look, they had the same amount of debt just a few years ago with only $9, $10, or $11 billion of cash on hand. So for those investors who liked Pfizer just a few years ago, this company is now actually a more attractive and healthier business because of how much cash pile they've built up over the past few years while maintaining or reducing debt over that same time period. So overall, Pfizer is in a much healthier financial position than they've ever been in. Of course, sales are going to decline. We all know that's going to happen, but they've had this kind of lucky bubble and period of time where they've been able to deal with their balance sheet, become a much healthier company, and going forward, I think it's going to lead to a lot of growth in their operations because not only do they have more cash to pay down debt, but they also have excess funds available for future research and development to grow their core business as well. And if we take a look at their latest investor presentation, over the first 3 quarters of 2022, they plan to invest $25 billion to reward the shareholder. They want to spend $7.8 to internal research and development, around $8 billion in excess, external acquisitions of companies or patents. Then they also want to pay out $6.7 billion in shareholder dividends, and they bought back $2 billion of their outstanding shares. So overall, this company has done a great job of reducing their share count each and every year as well. They went from around over $8 billion of outstanding shares back in 2009 to around $5.7 billion as of the latest quarter as well. So the company has a nice mixture. They pay out a growing dividend year after year while also reducing their outstanding share count, and they're also in one of the best financial positions they've been in a long time thanks to the pandemic bump. And if we take a look at that dividend, current yield at 3.6%, a payout ratio of only 24% of their earnings. Of course, as earnings fall, this number will fall as well, and the payout ratio will rise. And of course, they have a 5-year dividend CAGR at 5.5%. And if we take a look at their safety score, it does come in at a 75. So the dividend is considered safe, and Pfizer was the third company we're going to take a look at in the video. And now if we move on into stock number 4, we have ticker CSCO for Cisco. The company currently trades for $48 per share, and the tech giant is now down 12.6% on the 1-year chart. They trade with a forward PE ratio of 13.5 and a dividend yield that's above their average at 3.17%. If we take a look at their 2022 results, they generated $51.6 billion in top-line revenue, a slight increase over 2021, where they generated $49.8 billion. And what I like to see is this company generates their sales on a global scale. They generated only 58% of their revenue from the Americas and 42% from the rest of the world, so they're not solely focused on one geographic region for a majority of their sales. They generate nicely diversified global revenue, which is very attractive. We can see their dividend continues to grow, and if we take a look at their capital allocation, they accelerated their share buybacks in fiscal year 2022. They bought back 146 million shares, more than doubling what they did in 2021. And if we take a look at how they spent their cash over the past year, 45% of their capital expenditures went towards share repurchases, 36% went out to paying their dividend, and 14% went out to repayment of debt. And if we talk about repayment of debt, if we jump over to the company's balance sheet, they are in a very, very strong financial position for a company of this size. If we take a look, they have total cash on hand of $19.8 billion. And now if we scroll down to the company's total liabilities, if we go to the long-term section, they only have $7.6 billion of long-term debt on the balance sheet. So right now they have $19.8 billion of total cash, which they can use to deploy and pay off all their debt instead of over $10 billion sitting on the balance sheet. And what's incredibly impressive is how good of a job they've done reducing this debt level over the past few years. Back in 2018, they had over $20 billion of outstanding debt. Each and every year we've seen a major reduction in long-term debt down to only $7.6 billion. So they've cut off around 60% of their outstanding debt in the past 4 years, which is very, very incredible. And this company has now built up a fortress of a balance sheet. They're in a very strong and healthy financial position. And overall, this company, I do believe, will continue to pay out that growing dividend for many years going forward because I don't see their debt coming in any fear of reducing their dividend anytime soon. And of course, if we take a look at their outstanding share count, over the past 10 years, they continue to buy back more and more shares, returning a ton of capital to their investors. Back 10 years ago, they had around $5.9 billion of shares outstanding, all the way down to only $4.1 billion. And now if we take a look at their dividend scorecard, their current yield comes in at 3.17%. Their payout ratio is only 44% of their net income, which is a very reasonable amount that also allows them to grow that dividend going forward. They have a 5-year dividend CAGR of 5.55%, and we can see they come in with a very safe rating at 91. So again, highly unlikely we see a dividend cut coming from Cisco anytime soon. So this was the fourth company we're going to take a look at in the episode, and now if we move on into the fifth and final dividend paying company currently trading below $50, we have ticker VZ for Verizon. They currently trade for $40 per share. This big communication giant is beloved by dividend investors because they have an absolutely massive starting yield at 6.5%, which is incredibly high right now, especially for a company that pays out a safe dividend that's highly unlikely to be cut. So we all know Verizon, they operate in the communication sector, and this company operates a slow growing business. They see minimal revenue growth each and every year, and their cash flows grow by a slight margin over time as well. But if we take a look over the past few quarters, they've actually seen their operations improve, which is a great sign for Verizon investors. During the past quarter, the CEO announced that they saw positive subscriber growth for the first time in a long time. As well, they also announced they're going to reduce their 2024 capital expenditure budget by 25%. Over the past few years, they've invested tens of billions of dollars into building out their 5G infrastructure, and over the next few years, they were planning for that amount to be reduced because they've already built out the infrastructure they needed. They also came out in the latest report saying they're going to reduce their 2024 capital expenditure budget by 25%, which is incredible for investors because it shows what they've built out has worked. They have the 5G infrastructure in place already, and that allows for more free cash flow that can be used to pay down debt and improve the balance sheet, but also allow for more room to grow the dividend in the future because dividends are paid out in cash from a company's free cash flow. So overall, the latest report was very positive from Verizon. And if we take a look at their largest segment, which is the consumer segment, quarterly revenue was at $25.8 billion, up 10.8% over the prior year. So the company was able to grow their largest segment of their business in the double-digit rate year over year, which is incredible to see as well. So overall, Verizon has been posting some pretty good quarters as of late, and I think the future is going to be good for this big communication giant. And if we take a look at their cash flows, Verizon is a cash flow machine. If we take a look at the cash provided by operating activities over the past 5 years, it continues to expand year after year to over $40 billion. And taking a look at their dividend, a current yield at 6.5% of course is very high and very attractive for most investors, a very safe payout ratio of only 50% of their earnings. They do not grow their dividend at a rapid amount, averaging only 2% annually. But if we take a look, a very safe dividend rating at 87, so this company pays out a safe and consistent dividend that is highly unlikely to be cut anytime soon. So overall, definitely another name worth taking a look at. So Verizon was the fifth and final company we're going to take a look at in this episode. Of course, we went over Bank of America, Hormel Foods, Pfizer, CSCO, and now Verizon. Those are 5 dividend-paying companies you can take a look at right now from 5 different segments of the market, all trading below $50. They pay out a growing and safe dividend to their investors each and every year. So please hit that like button and subscribe if you already haven't done so. Thank you for sticking around all the way to the end, and I will see you in the next video.